Hi everyone, Mansell from Soren Financial. I've been meaning to do this since the beginning of the year and to try to keep things monthly. This is the first one, but I promise I'm going to be keeping these videos regular just to keep all of our clients updated on what's going on in the market. So let's address the golden question. Where will rates go? I hate talking about rates, if I was to be totally honest with you. It's obviously at the forefront of everyone's minds over the last 9 to 10 months. The media talks a lot about rate fatigue. I definitely have it. When I look at things like rates, what I prefer to look at is what I can control rather than what I can't. Rates, in my humble opinion, will be heading towards 6%, and then we will start seeing them subside. I'm not an economist, but I have been buying and selling property since my early 20s. I'm in my mid 40s now. Especially with what's going on in the US with their banking system, it's anyone's guess what's going to happen, but I'm following it very closely. The issue that we have is as the rates climb, it's going to in the US, it's going to climb here. The reason for that being, well, one of the major contributing factors is that our banks get their cash from Europe and the US, and they are not at the end of their cycle, although the US say that they are close to the end. What we can do on our end to try to mitigate some of these macroeconomic changes is simple things such as making sure that we're using our offset account. Are you being paid into your offset account, and are you paying bills out of the offset account? That's something that's really important and something that I would highly recommend. Simple things such as refinancing as well. I'm not just saying that because I'm a mortgage broker, but refinancing should be done every, I'd say, 18 to 24 months. So that needs to be something crucial. Now, you may ask, oh, well, why is that the case? Well, the way the money markets work is that new money is always going to be cheaper than old money. So what I mean by that is, if you're borrowing money again from a bank via refinancing, that's new money. You're going to get it at a cheaper rate than if you had refinanced or purchased 18 to 24 months ago. My personal advice to clients as well is to put off any large purchases. So things such as upgrading the car, because, generally people are borrowing money to do that, and the rates for car finance at the moment are 10%. Anything like that can be postponed just until we get over this hump of high rates and high inflation, I would highly recommend. Should I look to refinance? This is a question that obviously, as you can appreciate, we get asked a lot. We have a look at our clients' loan structures every 18 to 24 months. So we have a look to see whether you're with the right lender you should be with. Obviously, as you can appreciate, lenders change their products a lot, and they do that based on their sort of varied appetite for risk. Okay, so obviously, as you can appreciate, a lender might not want to be taking on 90% LVR loans, especially at the moment with property prices going backwards. So then they'll reduce their risk for that type of business. Like I said, we have a look to see, if you're with the right lender. As you can appreciate too, like I explained earlier, new money is cheaper than old money. So obviously, we're always looking to see clients can better off moving. Obviously, in the spirit of full transparency, mortgage brokers are paid again, right? So we're motivated to move you to another lender, but that's not really how we operate here at Soren Financial. What we do is we recommend that you speak to your lender first. We'll have a look to see what the rates are for you, and we'll arm you with that information, and then you can contact the bank and say, hey, look, this is what my broker can get me. What can you do? If they can match it, stay with them. But if they can't, we'll look to move you. If you had a look and worked it out, and I have done this, worked out how much money you will save by moving every couple of years, even just over a span of 10 years, it's well over $80,000, okay? Because there's compound interest effects, there's obviously the cashbacks that the lenders give you, and also the savings you get from the shave off the interest rate. It's a significant amount of money. And if you look at the $80,000, and look, I worked this out on an average loan size of $1 million, but if you look at all of that and what that would do, for example, if that money was sitting in your super, so if you made an extra super contribution off the savings of your home loan, it's definitely going to affect the retirement that you have moving forward or when that time comes. Should I look at buying? Here's an interesting one. Now, it really depends on where you are in life and what your current situation is and what it will be like moving forward. Let's call it in the next 5 years, okay? Let me give you some examples. I have a client who's looking to retire in about 15 years. Now they're looking at purchasing something in their self-managed super fund that they've created, and they're going to look at buying something in and around Badgery's Creek. Now the airport, once it's open, which is flights are expected in 2025 to start, I think it's October 2025, they're looking at employing about 30,000 people out there, okay? There's a lot of infrastructure projects going on out there. Westfield is launching out there. There's a Hilton hotel. There's a whole bunch of different things going on out there that I'm hearing from agents in and around that area. It's a pretty good bet, to be honest, if you were to do something like that. But for this client, they're looking to park it, buy 1 or 2 properties in their self-managed super fund, leave it there for 15 years. Rent covers the mortgage plus their compulsory super contributions, so they're neutrally geared. And the aim is that when the time comes, they'll either sell it or they'll live off the rent. Okay, so for that person, I'd say, yeah, it's a good time to buy because there's a lot of price pressures out that way. So people who, might be on fixed incomes have to sell because of rates. That's scenario number 1. Scenario number 2 might be you're close to retirement, right? And what I mean by close is, it's within the next 3 years. I'd probably say no. Actually, let me add an asterisk to that. It really depends on where you're buying and what your strategy is. So if you're looking to buy an apartment and you're looking to do that in the city, whether it's Melbourne City or Sydney City, reach out to me. And what I'll do is I'll pull some reports on the suburbs that you're looking at. And let's have a look at the rental yields in that area. And let's have a chat about your specific strategy. Okay, so I don't have a blanket answer. It really depends on your scenario and what your strategy is and when you plan to exit. So what I mean by that is when you plan to sell. So self-managed super funds. So this is for people who don't know how to set one up or how it operates, but here are some key points. So the first thing that you would do is if you had a self-managed super fund, generally the recommendation by accountants is, and I recommend that you do speak to your accountant about this, is that there is something between 250 to 300k in there. Now, there are about 4 lenders that do self-managed super funds. All the big guys got out of the game just due to compliance. It's just a lot of headache and hoop jumping that you need to do. So you're going to see a lot of the big guys don't do it anymore. How does it work? So you have one set up by your accountant. Ideally, you want 250 to 300 grand in there. So some people will obviously join with their significant other, and then you can use those funds as a deposit to purchase a property, and you get a loan inside your self-managed super fund. Now, the great thing about SMSFs, whatever your borrowing capacity is outside the SMSF, let's hypothetically say you've tapped out, okay? So you can't borrow any significant amount of money to purchase property. The way the serviceability works inside the SMSF is it's independent. Whatever the cash is that's sitting in there, you can use that as a 20% deposit and borrow the remaining 80% against the property. Now, a couple of things that you need to remember. Do SMSF loans is each of them has different rules around liquidity. Now, what I mean by that is, let's say, for example, one lender wants 5% liquidity. That means you need to leave 5% in cash sitting inside your super. Well, one of the advantages of buying inside your SMSF is that obviously you're contributing to your SMSF on a monthly basis, right? Through your own super contributions. So you're using those funds to invest, hedge against inflation, and set up your retirement. Okay, so it's something that I would definitely, if you do have access to around 250k, I would be having a chat to my accountant and seeing if this is a worthwhile exercise. And that's a wrap. Thank you very much for watching. I really appreciate it. And if there's anything that you want me to discuss specifically, or if you'd like to have a chat as well, please reach out. I'm more than happy to share any intel that we get from the banks, as well as any of the market updates that we're constantly keeping our finger on the pulse on. And we will see you again soon. Cheers.